Good afternoon and good morning, everybody. We've reached a time where we're beginning. We wanted to give some time to attendees to come through. Welcome, everybody. Thank you so much for taking the time. This is one of our first virtual workshops. We previously had these in person, and now it's virtual, so everybody can attend without having to leave their computer. So wanted to take the time to introduce and thank everybody for coming today. My name is Marvin. I am one of the facilitators and moderators today. And today what we're going through is some of the questions that have been asked online, through social media, on Twitter, on LinkedIn, across a bunch of different platforms. And today we're here to present a lot of these different answers related to fundraising on the African continent, when it comes to diligence, to valuations, all the different things that has been asked. So I am going to share my screen as we begin, because a part of this is going to be introducing the wonderful set of people who took time today to be here. So I wanted to first ask, can everybody see my screen? Just confirm, either one of the panelists can confirm, or chats. Okay, we can see the screen, thumbs up. So welcome to today's workshop. And thank you again for taking the time. And as part of the workshop, we wanted to first start off with getting a sense of what we'll be talking about today and what the agenda is going to look like. So for that purpose, here's what the agenda looks like. We're going to do some brief introductions to understand who's on this call, who's facilitating, who's a part of this. Next, we're going to break into a session in the same channel, no need to go anywhere, where we're going to be talking about specifically 3 topics. How do you perform due diligence as an investor, or how do you prepare due diligence as a founder of a company? How do you prepare valuation as a founder, or how do you think about valuations as an investor in the company? And then lastly, we're going to be talking about what cap tables are, what equity is, and how safes work, or convertible instruments that I'm sure a lot of people have seen or talked about or been exposed to. Next, we're going to go into open questions and answers from you, everybody on the call. So there'll be a session where you can pose questions, and I'll go about that in a second, and then we'll be answering them. And as a part of this entire workshop, we aim to make it as interactive as possible. So every question that will be asked today has been provided either by yourselves, your colleagues, your friends, online. So everything is coming from the community and the platform directly. I will respond to these questions directly on the call. The last part of the call is going to be a space dedicated to where we talk about actionable things that you can do. Once you leave this call, what can I do to put my company in a better place to succeed and fundraise? What can I do as an investor to put myself in a better place to invest in the next best company in the world? And at the end, we're going to go over a surprise that we have for everybody who's attended this call today. Will be, especially founders, will be issued what we've called a founder's toolkit. So that founder's toolkit will have a summary of this call, along with free contracts, a simple diligence checklist that you can use to prepare a data room and a round for investors, as well as a sense of how valuations could actually work. All of those things are going to come to you for attending today, because we know everybody's busy, so we appreciate your time so much. Those will be sent to you on Tuesday next week with the toolkit via email, and we'll go over what that means at the end of the call. And today we have wonderful people who've taken so much time out of their calendars to be here with us today. Would like to introduce each of them, and as I introduce each of you, Nivesh, Jessica, the team, please just say a couple words about yourself. So I'll just start from the left. Nivesh, please, welcome today. Tell us a bit about yourself.
Thanks, Marvin and team, for having me here. Yeah, quick background. So I'm a VC principal at Newtown Partners, which is a early stage investment fund manager focused on logistics technology, supply chain technology, and health technology companies across the globe. I also do work for a pre-seed or pre-series A focused fund called Launch Africa, which is kind of sector agnostic. I've got around 6 years of African tech investing experience. Thanks.
Thanks for that, Nivesh. And Tina, welcome.
Hi, everyone. My name is Tina Nyamache. I'm the Chief Growth Officer at Raise. And my role at Raise is basically being the advocate for the customer and making sure that we're building our product to fit what the market needs. A little bit of background, I have been working in the startup ecosystem for the last 80 years, 8 years, not 80. I've worked for an accelerator, incubator, VC fund, and now I'm in the startup scene. So glad to be here.
Thank you, Tina. 80 years is definitely before any startup really existed. So you've been around forever.
Yeah, incarnating.
You reincarnated to bring the content to the next level. That's correct. And Rishabh today, welcome.
Thanks, Marvin. Yes, so I've worked in VC at Energy Access Ventures, focusing on the rural electrification and energy access industry across Africa. I've invested both at very early stage investments and fairly late stage investments. I have also spent a few years as the head of business development for Good Life Pharmacy, which some of you might know, where my role included growth itself, growing the entire brand and infrastructure. And I also dealt with the investor relations in my capacity as head of business development at Good Life Pharmacy. And currently I work at Raise as part of the engineering and product team. So yeah, glad to meet you all and pretty excited about today.
Welcome, Rishabh, members of the Raise team. And Mark, welcome today.
Thanks, Marvin. Good morning, good afternoon, everybody. So my name is Mark. I got multiple caps, actually wearing multiple caps. So I worked 17 years for Microsoft in Africa, mostly on the continent as their chief technology officer for Sub-Saharan Africa. So been entrenched in the technology field for many, many years. When I left Microsoft, I get back to consulting and starting to actually consult in the coaching and in the startup space for an incubator here in Mauritius called Turbine. And so almost fell in love with startups and that world. And that led me actually to do two things. First, to launch a podcast called Entrepreneurs Talk Africa, focused on really entrepreneurship in Africa, and founded a first syndicate business angel group in Mauritius called Mo Angels, which I co-founded with three co-founders. And so we're looking into early stage startup post revenue. But yeah, very, very happy to be here sharing some experience with you guys.
Welcome, Mark. Thanks again for your time. And Jessica, welcome today.
Thank you, Marvin. Good evening, good morning, good afternoon, everyone joining us. So Jessica Colasso, I do wear multiple hats, but as of today, I'm an entrepreneur and I run an HR tech startup called Brave. Our focus is workforce planning for companies with a workforce of at least 500 people plus. We also used to do product recruiting, but we do that on a consultancy basis. Apart from being an entrepreneur for the last 5 years, I used to be on the other side of the table, where I used to be part of the founding team at the iHub for about 5.5 years and enabled the rise of what we call the Silicon Savannah today. We started the iHub for developers and saw the rise of entrepreneurs. I actually took a leap into becoming an early stage investor. The first time I invested in a company was 2010. I had no idea what I was going into, so today would be a good chance to learn about how to go into angel investment if you're interested in that as well. And I've invested in so far about from 2010 to 2015, when I stopped investing, about 5 companies. 3 of them are doing well right now, and I'm just waiting to see for their progress. And today I'm here to share my knowledge with you on both ends of the spectrum. Glad to be here.
We're glad to have you. So there you got it. We got people here who are ready to answer the questions, prepared to answer these questions. And then of course we have all these wonderful attendees, the long list of your names that I won't read out, but again, welcome to be here. So as a part of this today, I want to give you a sense of what's going to happen today. So we've seen the agenda, and in this Zoom call, everything is going to be interactive. So throughout the workshop, you'll see a poll pop up on the left. It'll kind of look like this. It'll just pop up on your screen. You'll be able to answer it, and then we'll all be able to see the results. And then we'll use those results to inform the discussion that we have across the different groups of people today. The second part is that we're gonna have, please post your questions at any time. I've already seen some rolling through, but during the conversation in the agenda, we will have an open question and answer period where you can type these questions. You'll see it kind of pop up this way if you click on the bottom of your screen, and you'll be able to answer ask these questions, and we'll be able to answer them. So an overview of what we'll be talking about today. So there's 4 topics we're focused on, all revolve around fundraising. First one is on diligence, on how does it mean to prepare diligence? What does that actually mean? What do you need to prepare? Second is on investor relations and networking. The third is on preparing a valuation and understanding what that means. And the last is on how do you think about cap tables, equity, all these unnecessarily confusing terms that as founders and investors, we got to deal with on a daily basis. So today, before we get started with the different panels, again, an overview of the agenda. We will start with a high-level overview so we get a sense of the language that we're talking about. And what we're talking about today is focused on fundraising on the continent. You are either a founder, investor, law firm, whatever it is in this ecosystem. And fundraising is just about doing one simple thing. You are selling equity to an investor in exchange for money. As an investor, you are putting in money into a company, like Jessica was saying, or Mark was saying, or Nivesh, into a company in exchange for equity. And in that process, from the founder side and the company side and the founding team side, there's 4 major steps to doing this. The first is that you need to organize your data, diligence, information into one place. Secondly, with that information and diligence, you need to be able to plan out what the fundraise is going to look like, what the terms are going to look like. With those terms, with that data organized, you would launch, that's where you have your nicely designed pitch deck, to investors to start having the conversation around what you're selling, how much you're selling, where the company is going. And as you do that successfully, which everybody in this call will at the end of this workshop, you'll be able to close rounds, which means that you'll be able to get investors to participate in your company, buy equity in the company and participate. So what that means is simple from a company perspective. And here we try to demystify these terms. When you start a company, you start off as a founding team. Everybody has a percentage of the company. So the company is split across percentages. As investors invest, as the company grows, the percentages change. So founders and the founding team might go from owning 93% of the company to now owning 58%, but investors might own 16% of the company. This continues as the company grows. As employees come on, investors come on, founding team grows, the percentages change, but the company's value is going up. So all of these different concepts around valuations, diligence, organizing your information, planning your fundraise budget and time, and don't worry, we'll come back to these slides when we get into the meat of the topic. Launching your deal rooms and funding rounds and then closing a round, all of these terms relate to each other. So the way this workshop has been designed is to be able to tackle all these concepts, demystify and make these concepts a lot more simpler. And in order to do that, Rishab is going to lead and facilitate along with Mark and the rest of the community we have here around valuations, diligence, and networking. So Rishab, we'll turn it over to you. And following that, we'll go into equity and cap tables and what that means. So Rishab, welcome.
Thanks, Marvin. Right, so obviously, while all of you were registering, we heard a lot from the community, a lot from you guys about what you want to know about. So we're going to cover some of the topics that were very popular in terms of what you guys are really curious to hear about. And with that, we'll actually kick off with a poll to get a better idea of how far you are into your fundraising journey. So poll should be popping up any minute now. Let's give it about a few seconds for everyone to vote. Yeah, let's give it just a couple more seconds, and then we'll close the poll, look at the results, and obviously we'll be able to use that information and make sure we provide relevant answers to all of you. All right, I hope everyone's voted. Yep, I think it's time to close the poll, and we can have a look at the results. Okay, so most of you are very new to fundraising, so we'll definitely keep that in mind and make sure we start at the beginning and then take it from there. So yeah, and congrats to those of you who have raised the seed round as well. I'm sure there's a lot to talk about. There's a lot to digest as well as you approach your next round. So I'm quite sure a lot of this will be extremely useful to you. So let's kick off with Jessica regarding some of the questions that were quite popular. So Jessica, I mean, you've got quite a bit of experience with iHub and quite a few different startups. Could you tell us a little bit about how founders start the process of networking and actually finding investors to actually build their network and start approaching those investors?
Yes, thank you, Rishab. So when I also became an entrepreneur, what I started with, I'll give it from a perspective of what I've done, and then I'll go backtrack to what entrepreneurs have done at iHub and post iHub. In the HR tech space, there are very few investors in this space, in this part of the world. So we actually had to put together a Rolodex. And what I mean by a Rolodex is a list of angel investors and VCs focused on this part of the world, investing in African companies. So that's the first step, like creating a list of angels, VCs focused on your industry vertical and what stage they're focused at, whether they're actually at pre-seed stage or angel stage. And I think like maybe there are some of the panelists can clarify the different stages, because we have different stages here in this part of the world. Like angel means different in the UK. So just compiling a list of investors. Then the next step is networking with your peers, your founders, and asking them. Some angels are agnostic, or VCs are agnostic. So asking them for doing your due diligence for the investor side, seeing what their appetite for risk is, because I noticed some of from the poll, some of you are just about to raise or have never raised or in their seed stage. So the appetite for risk in that part of the spectrum, whether they're willing to actually put in money and work with you, and how much risk they have in case the initial business model doesn't work. So the next thing is like you can ask for referrals and email intros from your fellow entrepreneurs. Also, once you meet an investor and they're willing to put in money, bring an investor that actually invests time and is able to introduce you to his or her network of investors. And then I would say the third thing is you need to be confident. You need to know your facts and have your elevator pitch ready. Well, in this day and age, we don't do as many in-person events, but in those days when we actually had events at iHub and just about like a year and a half ago, you used to meet investors at some of these events. So find the right events to network, and even online, find the right events to network. And if you're on a panel or if you're doing a talk or anything for 15 minutes, sometimes investors attend these events to actually find what we call deal flow for their investments, and they'll probably get in touch with you. So try and be a bit cognizant when you're networking online and offline. And I remember I did a presentation at Africa Tech, the Africa Tech Summit last year in October, and an investor actually got in touch with me based on the work, and we are continuing the conversations so far. So I think just be a little cognizant of like what events you're attending, who's attending online. So it's all about knowing your facts, your due diligence, knowing your network, and really doing that analysis. Thanks.
So I guess just a follow-up question on that, because obviously I think quite a few people are new to this. Obviously, a lot of people do want to build their Rolodex, but where do you start? Do you have any online registries you can suggest to our audience?
Yes, there are actually online registries like Telcom Capital, which has invested, and they have the Tide Fund, did create an open source repository of angel investors and VCs online. And I also believe Village Capital at a point also did create a repository of investors as well that could be open. So they're all different, all these different players, whether they're accelerators or VCs in their own way, have created what you call repositories online, but they're all like scattered. So you have to actually like really Google and look for these lists, or actually like do your own scraping online. There's not one like central repository that you can actually like access all the investors like in Africa. But I think Telcom has the most comprehensive list so far from what I've seen. It was shared on a WhatsApp group, I think late last year.
All right, very good to hear, and very actionable. So thank you very much for that. So we had quite a few questions about obviously networking, which we've just talked about. But of course, once you've actually met an investor, a lot of people are curious about the do's and the don'ts about approaching investors and going into the entire due diligence process. Mark, would you help us with that? Would you mind telling us, talking a little bit about the do's and don'ts about approaching investors?
Yeah, thanks, Rishabh. I think the first don't that comes to mind immediately is don't go with your hands in the pocket, meaning that will be a casual conversation and not getting prepared. I think that you need to become, Jedi preparation, if I can say so. So, and that's really the most important thing is I would say the future of raising money lies into the first impression you're going to make. So if you are not having the right pitch deck, even if it's just a 2-slider, or even a 1-slider sometime, but if it's beautifully crafted and you've got, as Jessica was saying, your elevator pitch, that's the first good impression. Now, the thing that you need to keep in mind is if you go, I would say that first stage, pushing a professional image, knowing what what you're going to request as well. The thing is, you need to know that the investor will go through, and we'll talk about that, the due diligence process. So yeah, you'll do your pitch, to ask questions, they will want to know more. But as soon as you start, then you need to be prepared, because if you're not prepared at that time, and if you don't have, and I'm going to give you a couple of ideas there, very, very simple things that you need to have very handy, then you will basically break your professional image. So think about it that way. A company, irrespective of its size or its age, needs to focus on a couple of areas. The first thing, of course, is, well, the product or the service that you sell. What is your market? Okay, so the sums, total addressable market, and so on and so forth. So of course, you need to have that very clear in mind. So the problem you're going to solve, the solution you're going to provide, that's the easy piece. Now, sales and marketing. I've seen many companies say, okay, what's your marketing plan? We're going to do a couple of Facebook ads and reach out to LinkedIn, and then we'll sell the product. Well, unfortunately, that doesn't work. As I'm using to say to my startups, when I was at Microsoft, and Microsoft is a pretty big name, everybody knows it, and Microsoft is spending actually billions of dollars every year in marketing, but with a very, very stringent plan, and we know exactly what we're going to do, we know exactly what we're going to measure, and if Microsoft needs to do that with that massive brand, imagine that when nobody knows you, what you need to do. So you need to have a marketing plan. You need to know exactly what your KPIs are, where you're going to go. And so if you have, again, a one-pager or just a Google sheet, brilliant. That's the bare minimum. Financials is key as well. So you need to know where you're going. If you are post-revenue and if you have audited accounts, great. If you're pre-revenue, your forecast, 3-year, 5-year forecast, 3-year minimum, you know, with your COGS, with your costs overall. So again, a Google Sheet will do the trick. No need to go into really completely complex stuff. Legal, if you have multiple shareholders, you know, even if it's just 3 friends, how do you split the shares? Is it 1/3, 1/3, 1/3? Does anybody have majority? What is your cap table, your current cap table? So again, a very simple document. So, and if you go and, you know, and I can spend probably hours around that because due deal is very, very stringent, but think about all the aspects and have, you know, a document. And again, it doesn't need to be awfully complex. It's just a simple document that describes what you do, who you are, sales and marketing, financials, technology, your team, of course, who you are, you know, prepare your resume. Yeah, you're not looking for a job, you're looking for money, but, you know, we invest into a team and not just only into a startup. So to summarize, don't come unprepared, do come prepared, have all your documents ready, and have a pitch which is beautifully crafted.
All right, thank you for that. Yeah, that's really really interesting to hear, especially from someone who's gone through several fundraising rounds in several different companies. So that's really, really good to hear. Tina, it'd be interesting to get the flip side of it. Obviously, you've worked at Village Capital. You've got quite a bit of quite an understanding of what it's like to be on the receiving end of due diligence documents. What do you look for when you are considering an investment, and how do you go through your due diligence process, and what should founders consider as they approach you?
Thanks, Rashad. I think my analysis always evolves around 3 things: the technology or the product itself, the market that they're targeting, and the organization. So if I was to break it down, I think Mark has touched on a couple of things. When we're analyzing the due diligence, we look at the team, like how big is the team or how small is the team? What is the founding team? What skills do they have in terms of relevance or with the industry that they're in? I look at the gaps that is in the team, like what are the gaps that they have? What is their hiring strategy or hiring plan? Because that does tie up down to what they're planning, how they're planning to use their money. Looking at the organizational structure and the process, we also look at the problem. How big is the problem or the vision that they have? Is it aggressive? Is it big enough? Is it relevant, probable? The value proposition that they have, how do they differentiate themselves from their customers? I mean, how do they differentiate themselves from the other competitors or industry players? What evidence do they have for that? When I look at the market, is how big is the market? What is the total addressable market? Quantifying that. Looking at how much percentage of that total addressable market are they planning to acquire? Is it realistic? How do they plan to, they have to talk to us through like, how do they plan to do that? Which also goes into their sales and marketing strategy. What is their business model itself? How do they plan to make money, or how are they making their money? By this, sometimes we also look at their financial performance and their financial projections, which can also tell us the story of their financial growth and their scale strategy. Also looking at the product itself, zooming into the product, what is the risk of this product in the future? How are they planning to reiterate if the market keeps changing? Because like, if you're in the tech sector, it's like every other month, there's something new that is happening. So like looking at the industry that you're in, how fast is it moving? What are the solutions that are coming up? Are you planning to be, how are you planning to be ahead of that curve? And last but not least, we look at the exit strategy. So what is their exit strategy? How are they planning to exit us as an investor in the next 5 to 7 years or 10 years? What is that strategy for them? And something that I've seen a couple of investors now asking a lot is, what is their non-market strategy? Because now we have a lot of platforms coming into play, a lot of people who are building ecosystems within industries. So how are people planning to plug and play in there? Also, if you're planning to expand into new markets, there's regulations that you have to adhere to. What are the risks? Or how are you planning to mitigate those risks of entering new markets? How are you planning to build those relationships with regulators and policymakers? So that's like part of like non-market strategy for companies. So that, in a nutshell, those are some of the things that we look at when we're planning to invest in startups.
Great, thank you very much, Tina. And I love the point that you brought up around exit strategy, because I mean, you can't eat a share certificate. You need the liquidity if you actually want to succeed from the startup and take the financial gain that you're looking to achieve out of this. I'd like to turn over to Nivesh, who again can give us a deeper dive into that whole perspective. When a founder approaches you, what makes it more or less likely for you to invest in them when they actually approach you?
Yeah, thanks, Rishabh. And I think Mark and Tina have already kind of covered this, but the first thing that comes to mind or the first thing I'd like to explain to kind of founders is just to note the kind of life of an investor. And some of the other colleagues will speak from experience about this, but you're receiving 30 to 40 pitch decks or emails a day asking for funding, and it's kind of humanly impossible to go through everything with the same level of detail and rigor, and therefore putting your best foot forward is going to get you a better chance of me opening or someone else opening the email and going through it in detail. So just with that said, I would say the first thing and probably the most important thing is just being prepared. So like Mark touched on it, the more prepared and more serious you are as a founder when you're raising capital and approaching investors with that mindset, the more serious they're going to take you and the more time they're going to allocate to your kind of application or your pitch deck. And what that means about being prepared is kind of everything Mark's already spoken about. But I guess to kind of put a different lens on it is just understanding what investors look for, which Tina's already spoken about. And if you know what investors are looking for and you prepare your pitch deck that answers all the questions, you provide them all the information they need, whether it be financials, whether it be company certificates, whether it be founding team CVs, you're much better positioned for an investor to want to look at the business. I think maybe Jessica mentioned it earlier before, but I think what's also important is knowing what investors to approach. So, some investors are sector agnostic, some investors are vertically focused or geographically focused. So, if you're a startup that's based in the US and you do agri-tech, but you approach our fund, for example, it's because you haven't researched that we don't look at agri-tech, it's kind of a waste of your time and a waste of my time. So I would say it comes back to everything about just being prepared, doing the work on your side, understanding what the investor's looking for, understanding how you would fit the investor's kind of mandate and what other companies investors have invested in that could potentially give you a warm introduction or someone in your network. So I don't know if that kind of answers the question.
Definitely. And I think it links in very well into Jessica's earlier point about having that Rolodex ready, because the networking does start at that level, trying to understand which investors you should be approaching, and that gives you a better chance of actually gaining investment, which is of course what we're trying to do here. So I think,
sorry, Rishabh, if I may chime in just to complement what Nivesh has said, because I mentioned due diligence, and I think that what a startup needs to do is to do due diligence on the investors as well. Understand who you are talking to. As Nivesh is saying, if you're talking to the wrong guy, because the investment thesis is not is opposite to what you're looking for as an investment, then you're wasting everybody's time. And everybody's time is precious. So do your due diligence before.
Thank you so much. Yeah, the moment you said that, I could see all the panelists nodding their heads. So definitely a very relevant point. So yeah, I think those are the questions we had regarding due diligence and networking. And I think we'll move over to the questions regarding valuations. But just to summarize what we've heard, obviously we've talked about, and I'm trying to summarize, three real actionable points. Jessica, of course, spoke quite a bit about networking. So for our audience, just keep in mind TLCom, Village Capital, some of the places you can go to grab some information on which investors are available and actually start doing your due diligence on the investor. Obviously, there's a few others that come to mind for me. Parity, Brighter Intelligence, VC Foray, Startup List, Africa, all very useful resources to go to actually look for investors. Have a look at them, research that, and continue going forward. And touching on due diligence, obviously we said we have to be prepared, make sure we have the right documents in order. Obviously that's quite a range of things. We talked about having your financial models ready, having your pitch deck itself, having information on the market and how you fit into it. All of that's incredibly important, and that's something that should be actionable. It's worth saying that at Raise, on the Raise platform itself, we do actually provide a data room, which can be used as part of the investment process. And you can actually create that data room and invite investors into it so that they can have a look at that due diligence information. Regarding some of the other information you would need as part of your due diligence process, it's worth Googling things. I think Airtable has a template for fundraising. You can also build your pitch decks on Parity. So have a look at those tools. I think that's probably going to help the fundraising process. So now let's jump over to questions regarding valuations that seem to be coming in from the audience upon registration. So we're going to put up another poll to get a better idea of where everyone is regarding their journey in valuation. So polls should be popping up soon, and we'd love to understand more about you guys. So we'll just give it a minute. Yep, hope everyone's managed to answer their poll. I think it'd be good to get the results now. Okay, so well, it looks like a lot of you are very, very new to the whole valuation process. And I mean, it's great to see some of you have actually built your own valuations. But for the vast majority of you, I think this is a great workshop to be. We'll dive right into that. And also really interesting to see how the split across industries are, because obviously valuation does change across different industries. We've got quite a few people in fintech and crypto, and quite a few people around B2B services. So that's quite interesting to see. So let's dive right into it. Again, I think we can start with Jessica. Would you mind just giving us a very quick overview about dilution and how it relates to a cap table? Because obviously you've been on both sides of the table regarding that.
Yeah, so I will be on the spectrum of, like, at Brave, we've created our own valuation because, like, the founders, especially the CEO Idanga, understands how to build financials, and we've been able to benchmark on, like, going on Crunchbase. Normally, when you're building financials, you actually need to know what you're doing. So you need a bit of, like, financial background and financial advisory background, which are two different things, and probably Mark can go into the specifics of that. But once we built our initial financial model, we used benchmarks. And what do I mean by benchmarks? You look at what's out there in the market, and you see what other companies have benchmarked against. Like in Africa, it's a bit difficult to get data on the HR spectrum, but like I've seen some of you in logistics and crypto and B2B, they've been like a standard valuation of if you're going into a pre-seed round, like normally they say like standard valuations are at least 1 million going into the angel round. And what I mean by that is post money. All this, I think, let Mark clarify all the post money, and I'll give him a chance to talk about that. And so I'd say, like, looking for valuations, I hesitate a bit, Rishabh, because I don't to give the advice to entrepreneurs on this call, like say go out there and then value your company for 1 million post money and then go and raise money, because that's what's been done in the past. And a lot of startups, like the ones I've invested in, have got burnt, not by angels by myself, but shark angels who have taken more equity than required. But my final say on this is you look at the total addressable market, and you look at like benchmarks, and you can actually like say, according to this is what companies at this stage are kind of like valued at. So I'll just keep it very open. Yeah.
Fair enough. Yeah, that's it's good to understand. I think definitely we want to hear from Mark, especially regarding the founder side of things. But Nivesh has quite a strong background in accounting and finance, and I think getting a good picture of how valuations work and how to actually come down to a figure for valuations, it'd be really good to hear from you, Nivesh, regarding really coming down to that number and how qualitative factors might affect that number.
Great, thanks, Rishabh. I think Jessica kind of touched on it when she was explaining her views on valuation. I think the first thing to note is just company valuation differs largely by the stage of fundraise. So it's going to be different for angel, seed, Series A onwards. But more importantly, it differs by the underlying investor. So depending on their size, their industry, their geography, who their LPs are, what their preferences and experiences are, it all differs. So effectively, there is no universal valuation method applied by every investor to come down to what a company valuation is. And it's slightly a bit of hit and miss depending on who you're dealing with. There are, however, a few common methods that investors use, mostly institutional VC investors that we've come across and from my experience. I would also say that the kind of VC company or early stage investment is a bit of science, but also a bit of art. At the end of the day, there's no formula that's going to give you the right answer for what your valuation would be. And at the end of the day, it's what someone is willing to pay. So Mark would be willing to pay $1 million for a company, and I may be willing to pay $100,000 for a company. And effectively, what an independent third party is willing to pay for your business is a fair market price. But maybe I can just dive into some of the routines or the methodologies we use, and I've seen some VCs investors use, and I'm sure the rest of the panel have used that as well or come across it. So I would say probably the most common methodologies when valuing a private company, and this would be earlier stage all the way to kind of private equity, would be the following. Firstly, a discounted cash flow valuation. I'm sure most of the parties here know what that means, but that's all that entails is forecasting what the future cash flows of the company will be, and then discounting that back based on what the underlying risk of the company is. I must just note that for an earlier stage business, it's very unusual for an investor to use a DCF just because it's highly assumption driven. And at an earlier stage, you generally don't have any basis for justifying the assumptions you're making. And a small tweak in those assumptions makes a massive difference in the valuation. So yeah, that's just one type of method. Some companies may use it. What I've seen be used more often and is probably more market standard is using comparable company analysis. And what that entails is just trying to determine a valuation for the company based on relative other company valuations. So for example, we'd use multiples, and what we use probably every day in kind of determining what the valuation of a company would be is we would look at the market and we would say, cool, if we're looking at a health tech startup that's operating in East Africa, we will go and look and try and get data on, the last 5-10 rounds of similar investment that health tech companies operating in that region have raised money at. And let's say that is, based on 5 to 10 times revenue, last 12 months revenue, or 5 times future 12 months revenue. What we would then do is apply that multiple to the underlying company's revenue, and then get kind of a ballpark valuation. You could use different kind of underlying denominators for determining what multiple to use. Revenue is probably the most important, just given the stage of business, but later stage businesses would use, cash flow, EBITDA, net profit, whatever that may be. But that's probably the most relevant and used method that I've seen in the market. Is just looking at, what have other companies raised that based on multiples of their traction, being their revenue, and how does that then compare to the underlying business we're looking at. And then another method is kind of just looking at other precedent transactions. So other companies that have raised similar rounds, but more on the actual valuation side. So, there's a general theme around, let's use health tech again, companies that are earlier stage and maybe aren't using a priced round and maybe are using a safe, which we'll discuss later. Generally these companies at a seed stage would raise at a cap of X. And that's something that you can use as a kind of comparable analysis of what is reasonable for your valuation. That's slightly more complex, and I know the team will get into that a bit later, but I just wanted to kind of explain that. And then probably another method that is very specific to VC, and not many VC investors use it, but I know earlier stage VC investors or even angels do use it, is the VC method, which effectively, and I'd love, probably everyone should just go and Google what the VC method for valuation is, because a calculation is always going to be better than me trying to explain it. But all that does is it effectively says, as an investor, I want to get X return. I want to get a percentage return on my investment. And based on kind of factors of the business and some assumptions, I know that I could probably get, a certain quantum of money when I exit the business in a period of time. And based on those assumptions, I can back solve what the company needs to be worth today for me to get that return if I'm going to get that exit. It's slightly more complex than that, and it's also assumptions based. I'd probably say everyone should probably just Google that. But yeah, those are some methods that people use and companies use and angel and VC investors use to determine a valuation for a company. I would say revenue multiples are probably the most used, and the rest of the kind of panel can add some information. I guess the difficulty for you as a founder, if we're trying to make it very specific, is it is tough to find data on what other companies like yourself, how much revenue they had when they raised a certain amount of money. It is difficult, but I guess that comes down to preparation, looking at some listed comparable companies as an indication, and chatting to people in your network is probably going to give you more insight than anything else.
Yeah, it's very in-depth answer. Thank you very much, Navesh. And it's definitely a very interesting subject, valuations. And for our audience, I'm sure if you look in different places, you'll get different answers, but it's about understanding what's most relevant to you. I believe it's definitely a little bit more of an art earlier on, and then turns into a little bit more of a science as you go on, as you generate revenue, as you generate more items in your P&L. That will really help you move towards a more mathematical process. But at the start, I think it's some of those qualitative factors that really matter: how well you understand your market and how big your market is and how that compares and so on. Obviously, something that we see quite often is overvaluation. Mark, maybe you can talk a little bit about that.
Well, I think that's, overvaluation is definitely something that I would say 90% of the startups fall into, and I wouldn't say it's a bad thing. And honestly, you know, if you look at what has happened on the African scene for the last 2-3 years, we've seen, you know, huge VCs entering that scene as well. And we're looking into, you know, investment over, you know, 10, 20, $50 million. And even for early stage, you know, in the millions, whereas it was probably 50 to 100 K, you know, probably 3, 4, 5 years back. And I think that if you look at, you know, small companies raising 1 million, 2 million, you say, hey, why not me? And then you start scratching on a napkin, say, okay, if we make that number, okay, we take the revenue, we multiply by 10, and then, okay, that's a $2 million for 20% equity. That seems cool. And then when you go to an investor and looks at you and says, well, it's a little bit overvalued. Is it bad or is it good? I wouldn't say neither nor. I think it's, well, everybody's make mistake, as Nivesh was saying, at early stage, it's more an art than a science. Multiples is probably the way to look at it. But the thing I want to emphasize here is valuation is not a one number that you're putting on a sheet and that's over. Because if I'm an investor and I say, I'm interested now to invest, of course, every time as a startup you pitch, there should be, my request actually for all startups that pitch is have an ask slide. So your last slide should be, we need that amount of money to do this for that. And that could be debt. And we talk about, you know, the different ways to invest, but there needs to be a clear view of how much you want. And so there is the ask. And of course, sometimes the investor will say, okay, we'll look into it, and they will subscribe or oversubscribe. And we've seen a couple of rounds recently where the guy's coming with $250,000, $500,000 request, and actually our investors were oversubscribing because the company looked very promising, and so a lot of, you know, excitement around it. On the other side, well, you can have $500,000 and get, you know, just 100% for that amount of equity you were giving. So it's really, again, you know, it's something which is difficult to do. But whether you're overvalued or undervalued, what I want to emphasize, there will be at least 2 rounds, okay? Because anyway, before the investor issues the term sheet, and so basically structure the whole deal, there may be another set of negotiation, and we may come up with a completely different number. So it's not a fixed number at one point. The number will move. Of course, as Nivesh was saying, it will move along the life of the company, but even in one investment round, the number will move as well. So overvaluing, fine. Undervaluing, fine as well. But, you know, we need to find the balance.
Right, and I think obviously there's a whole point about, I mean, especially when you talk about comparables, if we're talking about a fintech company in the US or in Europe, it's going to be very different to a fintech company in Kenya or in Nigeria or in South Africa. And obviously those are going to affect valuations, and we have to be cognizant of which market we're in. And of course, you know, we're expecting our companies to grow. So we need to make sure that whatever round that we raise, it gets us to the next round, and we have to understand what we're trying to do between rounds, and really link however much we're fundraising to that. I think Tina's got quite a bit of experience with understanding round sizes and fact checking them when founders come to her. So Tina, would you tell us a little bit about checking the size of rounds that founders are asking for, or the amount of money that founders are asking for?
Thanks, Rishabh. When we're looking at the fundraising size, we always look at the stage of growth of the company. What industry are they in? What is the use of proceeds? Like Mark said, the ask that they have in detail. So if they can walk us through how they plan to spend the money, then we, you know, that can help us understand, like, how are they going to do the execution once they get the money. I think that plays a big part of the funding side. So looking at how much money is going to product, how much money is going to market, salaries of existing team or new hires, expansion strategy if they're planning to expand into new markets, other operating expenses. So I think that's a big part of what determines the funding size.
Yeah, I think that's very important, and that's exactly, I think, what we touched on in terms of being prepared as you come to an investor, knowing what market you sit in and knowing how you want to grow within that market, knowing your price point and knowing how that changes and how that links into marketing and so on. So yeah, obviously knowing exactly where your money is going to go, balancing that with the valuation that you'd have calculated with some of what Nivesh had said. I think will lead to an understanding of how big a round should be and how much equity to give away. Obviously, it's very important to balance. I mean, as Mark talked about, undervaluation, overvaluation, it's very important to get that balance right so that you know that you're giving away equity in return for cash, and you're going to use that cash in a certain way. But obviously, if you undervalue, you'll be giving away too much of the company, and if you overvalue, you're going to make investors very shy. So yeah, that's quite some important points. I think in terms of actionable items, what would be good to look at for our audience, look into some of the methods that Nivesh talked about. He touched on DCF, comparables, multiples, understanding the ROI for the investor. So it's actually important to try build out your model until sort of closer towards an exit. And I think those are some of the very important points regarding valuation and understanding the size of the round and the size of the equity that you want to give away. I think those are the questions that we had received from the audience before the workshop regarding due diligence, networking, and valuation. Obviously, we had quite a few questions around equity, safes, and deal structuring itself. I'd love to hand over to Marvin, who can probably take us through some of those questions, and pass it over to some of our panelists who I'm sure will be able to dive quite deep into that.
That I can. Thank you, everybody. Rashad, for a great session. Hope we all learned a lot of information that's provided. Don't worry, we're going to summarize this information to the best of our abilities so it's available next week to everybody. And on the question of overvaluing, a lot of what I learned as a part of a company is from Tina herself. And often Tina has to take me in the cloud from the overvaluation temptation and bring me back down. So I appreciated that part of the conversation very much across the workshop. So for this part, we are going to go through, we have Q&A in a couple minutes. So we're going to go through this session on equity a bit faster with a couple questions. But first, we're going to run a poll. So this poll is going to be focused on specifically on equity, cap tables, financing. So if we can run that poll, you should see it on your screen in a second. My timer has started, so it'll be about 1 minute until we close the poll to see kind of results and then guide the conversation using the poll itself. So there's 3 questions. Do you know how cap tables work? Do you know how safes work? Where is your company currently incorporated? Safes are simple agreements of future equity. You might have heard them related to YC, and just you've probably heard that language or seen it written somewhere. That's what a safe is. All right, I think we can go ahead and close off that poll, see what the results look like. All right, so we had 47% of you in East Africa, 44% in West Africa, and 8% either in Mauritius or Delaware. How safes work, out of 45 people, 36 do not know how safes work, or at least being exposed to it for the first time. And then 9 people do know how safes work. And if the cap tables, you have 36 people out of 45 who do not know, so 80% what a cap table is. And then 20% people who do know what a cap table is. So maybe where we should start is, what is a cap table? So Jessica, what is a cap table? Walk us through that as simply as possible. What is a cap table?
Without being too I would say like dictionary related. It's also known as a capitalization table, and it's basically a spreadsheet or a list that actually shows you like the distribution of percentage of the company owned by founders, by investors as they come in each stage. And in a breakdown, it just includes overall equity ownership, and it's broken down into like preferred shares, ordinary shares, and I don't want to get too deep into it. You said as simple as possible. The equity table also goes deeper into showing like what the scenarios would look as like pre-money and post-money, and I'm bringing pre-money and post-money back because I think it's important as we go into the discussion for the audience to understand what these terms mean as well. So that's a breakdown of it. Just shows like if you have a company, this is your percentage as a founder, and this is what the percentage would be for investors if they put in X amount of money.
Thank you, Jessica. That was straightforward, and that's an awesome song in your background. So for the a dope song. There's two parts to the cap table. That's correct. There's one where there's just simple ownership of a company, and then there's the cap table, which is an Excel sheet that has all of the stuff we've been talking about, valuations, instruments, all that stuff is in there. It's a bit more complex. So a lot of companies were now West Africa, East Africa. In East Africa, if you've ever had a CR12 issued to you, if you were in West Africa and Nigeria specifically, you ever had a CAC issued to you, in Nigeria specifically. And then you see when you create a company, it has a list of there's this many shares, ordinary shares, common shares, there's this many people that own them. That is called ownership of a company. The next step, as Jessica described, is when you're going out to fundraise from Mark or Nivesh or Tina, and you're saying, well, I want to sell equity in my company, you need to be able to provide some kind of capitalization table, which is a cap table, that has more details on where the equity is going to go, what kind of scenarios, how do people own things. So to that point, there's different kinds of things you can do on a cap table. It's not just equity and safes. There's debts, there's grants. So Tina, what kind of different instruments can be sold by someone, or how can you raise funding different ways? And how do you think about what kind of company a company needs at different stages? What kind of funding a company needs at different stages, excuse me.
So I'll start with the different types of fundraising instruments. So as you mentioned, there's the equity, which you get money for equity shares of your company. So you give a percentage of your company for some money. There's the debt instrument, which is very traditional, especially in Kenya, asking for loans from banks. You pay it with interest over time. And then there's like pure grants, where that's just free money. You get it either from competing pitch decks, etc. But then there's the convertible instruments, which is the convertible debt. So convertible debt is an agreement with an investor where it has the principal amount that you're getting, the interest that you will pay over time, and a maturity date when you have to pay that debt back. But the good thing or the twist with the convertible is that upon the date of maturity, you have the option to convert it into equity. The other convertible instrument is KISS and SAFE. So there's Keep It Simple Security, which, as the word says, it's like a one-pager document that you're purchasing a share as an investor for the future. So you'll get to your shares in the future. And for simple agreements, the SAFES is simple agreement future equity, which is you're getting also, it's the same as similar to SAFE, you're getting the equity in the future upon the date, upon when the company has fundraised an equity round. So it will only convert when the company has fundraised their first equity or Series A round. The pros of using an equity, a convertible instrument for early stage companies is that you push back your valuation. So you can, if you don't know or you want to keep building your company, you can be able to push the value of your company to either do a valuation when you're doing your first equity round. The other thing is it's very simple to write up. You don't need a lawyer to do it. Also, it's very flexible for the founder. You can be able to keep building your company without having to answer to a lot of people who have shares in your company. And from my opinion, I think it's tailored to favor the investor because the con that goes into the disadvantage of having a convertible instrument, which is SAFEs, is that if you give a safe note to convert in the future with a discounted rate and a valuation cap, then there could be a case where an investor gets more shares in the future because they have decided to invest in the company early on and take higher risks. So you could be giving away too much shares of your company in the future. If that is your strategy, that's fine. But you have to think about how much of your company are you planning to give in the future. It is high risk for the investor because they are coming in not knowing if you'll be able to build up your company to a place where they can get their money back or the money can convert into shares. For companies, I would suggest that if it's early stage companies, it's most advisable to fundraise with convertible instruments because that gives you opportunity to keep building your company, do your MVP, acquire market, and then be in a position where you can go to the investors and say, this is what I've been able to build, and you can have an equity round with a higher valuation.
Thank you, Tina. So there's different kinds of things that could be done at different stages. And I think as well, it depends on the industry and kind of like the trajectory of the company. So it depends a lot on, sounds like it anchors a lot on the valuation and diligence question. So thank you for that. And as a clarification as well to what Tina was saying, when she mentions convertible instruments, SAFE is a kind of convertible instruments, just like convertible debt. They're called convertible things because they convert into equity. And we'll go over that in a second. So we really want to get through the Q&As because there's some great questions and some hands that are being raised. So what we'll do is Mark, Nivesh, Jessica, Tina, Rishab, I'll ask you one question. It's a one-word response. As an investor, and all of you have invested in companies, do you prefer straight up, let me back it up. I'm a pre-seed company coming to each of you to raise money. Would you prefer to invest equity or a convertible instrument into a pre-seed company? Answer which one, and then just a brief explanation of why, so we get kind of a good explanation. So I will start with Tina, because she just spoke, then Jessica, Mark, Nivesh, and Rishab. Tina, we're ready. I'm coming to you with the biggest pitch deck in the world. What do you want to buy?
I think I'm a bit traditional. I would go for a convertible debt instrument. Why? Because if the company dies or for some reason they're not able to continue growing, I'm among the first people to be paid back my money legally.
That's correct. That's very correct. Anytime you want a debt on the cap table, someone will answer. And I laugh because I asked that question to Tina, and Tina knows me as a founder and operator. So she's like, I want some interest and I want to be paid back first. So I appreciate that. Jessica, please, equity or convertible, and convertible could be debt or safe. Which one would you want and why?
I'm more of a risk taker, so I go for equity. And I think out of the 5 companies I've invested in, I have equity in 3 that are doing well. One is because it makes me an immediate shareholder and kept in the loop of what's going on. And also when I want to kind of exit at different stages, they know the founders are aware that after 5 years or 7 years, I want an exit. And I guess you have to do your home. I know you said one word answer, but I just want to give a little kind of like feedback as to why equity. I do my due diligence, and I know like the founder of this company and the traction of like fintechs and logistics companies, and what how they can go in this part of the market. So that's why I'd opt for equity. So I think the vertical also determines what you'd go for.
It is a big risk you taken. I respect it though, because then a convertible does not make you a shareholder. Only shares make you a shareholder. A convertible is like a temporary shareholder. So that's very correct. Mark, and then Nivesh and Rushab.
Well, I would try to simplify and probably oversimplify, but that's a good indicator. A company which is post-revenue, so meaning company is already, getting some customers, commercial traction. We see a good future, would go 100% equity. Taking the risk for sure, but betting for the big return. Pre-revenue, well, generally in my angels practice, we don't invest in pre-revenue, but it may happen for a very good promising company, and therefore I would go safe. It's just, well, if the guys hit jackpot, good for us. If it doesn't, well, fine. We'll find a way to get our money back one way or another. But yeah, pre-revenue equity, pre-revenue convertible and safe, post-revenue equity.
Thanks, Mark. And yeah, with the safe, the convertible debt, like Tina was saying, allows you to have a valuation cap, be paid back first, and get interest. So it sounds like a very useful instrument in that scenario. Nivesh, what about yourself? Equity or convertible, or a mix of both?
It's a tough question because my answer is it depends, because all the panelists have made valid points. It depends on the company, it depends on the opportunity, it depends on the geography, depends on the valuation. So obviously, if the company, like Mark said, generating revenue, operating in a great market, strong team, and there's an opportunity for an equity round which is cheap, I'd go equity. But if there's a lot of unknowns, if we're trying to, if there's no traction to determine a valuation, and if there's a lot of uncertainty, then probably would go with some sort of convertible just to make the process a bit easier. But I guess the answer is it depends, which is not a great answer.
It always depends, my friend. Thank you for that answer. And Rushab?
Well, I'm not sure how much there is left to say. I think I like both Nivesh's and Mark's answers because I subscribe to both of them quite a bit. I think Mark broke it down very nicely. Post-revenue, go equity. Pre-revenue, early stage, meaning pre-seed, seed. I mean, convertibles kind of make sense. Obviously, there's the case of trying to get in between rounds, in which case convertibles make sense. I personally prefer to know the founders for quite a lot of time. And if I'm comfortable actually, making a commitment earlier on, then I think I'd go convertible. Yeah, so that's me.
Thanks for that. So I haven't convinced y'all of investing in the company yet, but at least I know what y'all want. So now I'm a step closer to understanding what terms everybody wants, which is all different. So my chances of raising are very low. So one of the things as well in what came out across a couple of different conversations we had just now was that the earlier you are, the safer an investor would want to be. So if you're pre-revenue, as Mark was saying, or as Tina was saying, an early pre-seed company, you want to have some kind of convertible instrument. In the ecosystem, we see a lot this language of safe, simple agreements of future equity. So as we wrap up this conversation part about the equity, we wanted to just give a quick presentation of what and how safes work. So if everybody can see my screen, we're going to go through in a couple seconds how a safe works. So a safe, much like a convertible debt, is, sorry, let me back up. When you're fundraising, there's three kinds of things you can use. There are shares, equity, or convertible instruments, safes, and then the stock options that you can issue to advisors and stuff like that. And so when we're thinking about these different kinds of instruments, one of the things that we said just now about earlier the company, the more likely to use some kind of convertible instrument. Safes is a kind of convertible instrument, like a convertible debt. They are called convertible instruments because they convert. So these are the steps. One, you structure the terms of a safe or convertible debt using your valuation, your diligence, your metrics, all the data that we've been talking about today. You structure those terms. Next, you go to investors, like I just tried to and failed, where you sell to the investor the kind of instrument that you believe is best for your company and best for them ultimately. And those investors, like Tina will say, yes, cool, I'll take a convertible debt. And then in that convertible debt itself, there will be lines of information and legalese that will say, on the day that XYZ happens, this convertible converts into XYZ number of shares. So I'll say that one more time. When a safe is issued to an investor now, as a part of your company, is just a safe. It's just a convertible instrument. It's a 5-6 page document that they hold. But in that instrument, it'll say one day when this thing happens, when you raise minimum of $1 million, or you reach a certain valuation, or you raise a Series A, this safe or convertible debt will convert into a certain number of shares in the company. That's how safes work. So the mechanic of that work this way. You'll start off with a safe initially. Let's say you raise a $500,000 round, and one day you want to raise 1.5 million, then 3.5 million, 8 million, 15 million. One day that safe was issued at the 500,000 round, which is kind of like a pre-seed round. Mark, Tina, Nivesh, Rishab, we were all speaking about. One day that safe will say, literally, I want to convert into equity one day when you reach a series round. So when you reach a series round, as you see on my screen, all that safe then converts into equity in a company. And what that means is that every previous safe or convertible debt that was previously issued also converts into equity at the same time. So what that means that instead of having a bunch of convertible debts on your cap table or safes on your cap table or part of your ownership, now you just have straight equity and shares. So new investors will get their own equity in a new round. The investors that previously had safes or convertible debt, same thing. They get their equity and shares in the company. One easy way to understand how much you are offering as a company is a simple formula. You take the amount of money that you're raising divided by the valuation or valuation cap. That will tell you the minimum or approximately the percentage of the company that you're selling to investors. So if I'm raising $100,000 on a valuation cap of $1 million, 100,000 divided by 1 million is 10%. I'm going to sell around 10% of the company to raise that $100,000. And for safes, one of the things that's important to do, as we've been talking about, every safe, every convertible debt that you create needs to be a data-driven process. No one has time to be out here guessing, even though there's, like we were saying, there's an art to valuations and an art to building a cap table, which is true. That art is always anchored in data. The more data you can provide, like Rishab said earlier, the closer you get to calculations and filling up the P&L and profit and loss statements, the closer you get to having valuations that make a lot of sense. A lot of this stuff is very difficult to understand. So on the Raise platform, which I have on my screen now, there's a couple different tools that simplify this process. So first we'll look at safes, because safes, even though we've explained how they work just now, they get very difficult to calculate because they're tricky and cap tables are tricky. So in here, what we've done here is that there's a scenarios tool. In that scenarios tool, you can model out a pre-seed round, seed round, Series A round. You fill in the data. As you fill in that data, what we've done is your cap table, CR12, CAC, all that stuff is already uploaded. So you already know who all the shareholders are, how much a percentage of the company that they currently own. And then for each of these different scenarios, you can see the safes that exist. So Ocean Capital Ventures here has both a convertible debt of $1 million and a safe of $50,000. And here, that convertible debt has been accumulating interest over time. So now it has $300,000 of interest on it, but the safe does not, because safes are not debts. They do not accumulate interest. So here, if I want to find out what will my cap table and my ownership of my company look like after I've finished this round. So we tell you, so here, all of this data is being produced from your capitalization table or ownership directory immediately. And here you can see that Ocean Capital Ventures previously had a convertible debt, but that convertible debt has turned into 90,000 shares. That safe turned into 69,000 shares. And what that resulted in here on the right is a percentage increase of 2%, percentage increase of 2%. So now Ocean Capital Ventures went from not owning shares, as Jessica was saying earlier. Here, there's no shares allocated to Ocean Capital Ventures. But when they apply the scenario on the Raise platform, they can see that now they become a shareholder of the company. And what that means is, in this tool at least, you take these terms, you can model out as many scenarios as you need to understand. All of those terms are uploaded into a deal room directly. So if you follow all these steps, you'll be able to upload documents, model out different cap tables for investors so they can see this data. And then you can invite investors directly into the deal room and the diligence as part of the data and the valuation that you create. But all of this is being anchored by cap table, which we went over and Jessica explained simply for us. A cap table is simply a record of ownership. So here you see there's common shares, stock options, preferred shares. Then we have Ocean Capital Ventures, convertible debt, safes. And there's different kinds of safes, which I don't think we should go over now. But all of these things sit on an ownership table. You always want to understand what you're selling to investors over time, what you're selling as a part of the company in percentages. And these things allow you to do that. So some actionable feedback. Always try and store your cap table in an online tool, whether it be Raise, whether it be other kind of platforms. Excel sheets are great, but they're tricky because the formulas are tricky. Always understand as actionable feedback the impact of the cap table and the different instruments we were talking about earlier on the valuation and the scenarios in the company. You might go from owning 100% of the company to owning 20% by accident. Trust me, we've seen it. I'm sure everybody on the call has also seen it before. And when you run scenarios, always understand the future. So today you're here trying to raise 500,000, but where do you want to be when you're trying to raise a few million to continue building a company, if that's the path that you choose? So that's a big summary on equity, how it ties into valuation. And now there's some fantastic questions in the Q&A session. So we would like to switch to just focusing on Q&A. You can raise your hand in the Zoom channel directly. You can press on raise your hand. Otherwise, I think we'll start off with some of these open questions. Rishab, is that correct? And if so, I can start off answering 2 of these because they're equity related. So Rishab, let me know if that's the case, and then we can begin with answering these questions and then moving on to raising hands.
Yep, I think it's, yeah, we've got a few questions around safes. I think you're best placed to answer some of those. Maybe you can take them all at a go. So the questions we have is, whether a safe, well, someone's wondering if safes are really ideal. I think we touched on that a little bit. What safe terms should be considered, and any lawyers maybe you could recommend regarding safes. And then we can dive into dilution after that.
Cool. I'll take that. So answer them one by one. So the first question, all anonymous, so no names are necessary. The question is, I've read in some papers that safes may not be an ideal security. What do you think? So thanks for this great question. Safes are always not the best for different kinds of companies, but for early stage companies that are raising to build a company that is eventually going to be backed by venture capital funds or venture capital money in general, it oftentimes is going to be an ideal instrument. I'll explain why. As Tina said very well, when you issue a safe, the company doesn't yet have a valuation, really. So a safe is not shares. So when you issue a safe, it will say, we think that this safe will have a valuation cap. What that cap is, there's a maximum ceiling of the conversion of this safe into equity that I am going to be willing to bear. So for example, I might go to Jessica and be like, hey, can you invest $100,000 in this company for a $1 million valuation cap? One day, when we raise at a $15 million valuation, Jessica's shares cannot be valued at $15 million. They can only be valued up to $1 million. So mathematically, what that means is Jessica will get more shares than most other people because her shares are being converted from the safe based on the valuation cap that was lower than the valuation cap we raised in the future. So as Tina was saying earlier, what that means is that as an early stage company, you don't have the data yet, you don't really understand what you're doing yet a lot of times, you're still figuring out the market. It is too early to set a valuation on the company. When you invest in a safe, it gives you the opportunity and time to continue growing the valuation of the company over time. Whereas instead, if you issue equity directly on that day when you're still early, what you're doing is creating a price per share. So essentially you're locking in a certain valuation at that time and it was way too early for the company to be locking in a valuation at that time. So safes are not ideal for anybody, and it depends on your cap table and what you want to do and the kind of company you're building. But if you're building a company in the venture capital space, it is one of the easiest ways to delay a valuation without getting a valuation that's too low from the outset, because you're still figuring things out. In terms of the terms that are going to trigger, there's basically two terms that trigger. The first is if you raise a round where you're issuing equity. So when we see in the news that XYZ, Triple Cash raised Series A, so-and-so raised Series B, what that means is those companies are issuing equity in a financing round, that will always trigger a safe. So for Triple Cash, for example, I believe there is a Series A, Series B, as an example. Every safe that they issued before that converts into equity at that time. So that's one trigger. The second trigger, and is usually related, is you raise a minimum amount of money. So a safe or convertible debt will say, if you raise more than $300,000 or $1 million or $5 million, this will automatically convert. So you have to be careful of what that conversion actually is. And then the third example as well is that you can do a voluntary conversion. So an investor can come to you and say, hey, I want to convert this into equity now. And they're perfectly within their rights to do that. In terms of lawyers in East Africa can deal with safes, I do not have a direct answer for that. I hope someone else on the call does. Safes across the continent is still a very new concept. They've only been around for a couple of years now in the venture capital asset space, in the technology space here. And there's still, at least I see a lot of mistakes, both on the safe instruments themselves. For example, we'll see a Nigerian company with a safe that has Delaware law in it, which is legally incorrect. And a lot of lawyers would have drafted that for them. Or you'll see all kinds of different scenarios. So I haven't found law firm that specializes in safes directly. There's tons of law firms who do technology generally and startups generally, who would be a good resource to have. But always check out the different websites, blogs. You can go to getraised.io. In there, we always break down safes. In the platform as well, we break down safes. So with your lawyers who may or may not have experience in safes, all you need to do is invite them to the Raise platform, should you decide to use it. And in there, it'll break down this information very clearly for everybody. And then that was the last question on safes. I will take the last one. The last two I will take from Jakob and Ed, because they're very specific. So for Ed, the first one, the question is, does the type of entity affect the type of instruments you can use to seek investments? So yes, if you're a nonprofit entity, 99.99 times out of 10, you want to issue grant or debt. If you are a company, a private limited company, that means that company is being created to have shares. So the difference between nonprofit company is made up of shares. So it'll have 1 million shares. There's 10 people that own 100,000 shares each. There's 10 shareholders. That means that the company can constantly create new shares, issue shares, get money. So that is not limited. You can do anything in a private company. In a not-for-profit company, you're typically going to do either grant or debt, depending on the structure that the company has. But all of this stuff is anchored by the company's existence, how it exists, the structure it has, where it is in the world. To Jakob's question, I don't know if anybody has ever heard in safes of something called the most favored nation clause. It is an unnecessarily confusing clause, but what it basically means is that if I go to Jessica and say, Jessica, please invest $100,000 into my company at a $1 million valuation cap. Jessica says, cool. And then she says, but I want a most favored nation clause. The way I've understood MFNs, and I may be wrong, but if I then go to Tina and I say, Tina, can you please put in $200,000 in my company at a $5 million valuation cap? Jessica has the right, through the most favored nation clause in the safe, to ask for the same valuation cap, or at least be notified before that valuation cap is issued to Tina. So the idea is that you protect that investor from being diluted more and more as the company grows and continue issuing safes. And it isn't typically included in most like conventional safes. If you see it or know that it's there, you definitely got to flag it, because many companies will continue raising capital, issuing safes and caps at different times. And If you continue doing that, all of the investors before who may have had an MFN clause in their template safe that you created and found on the internet, you might be breaching your legal obligation to all of those investors and be liable for a significant amount of money, or definitely a significant amount of equity. So Rashad, I hope those answers were detailed enough. So please now, I think we can distribute the rest now that we're done with safes.
Definitely, yeah. I think we're going to try answer a couple of questions, you know, just on the chat itself, because we're getting quite a few of them in. Nivesh, would you like to answer the question asked quite early on in the workshop? It states, it's anonymous. In terms of valuation, when pivoting from consulting into an investable product business, does it make more sense to set up a new entity or include income from your services that have been continuing?
Yeah, great. I think I did answer it, but probably on a different question. But yeah, I think this is something that's super common. You often see it. A lot of companies start through selling their service or their skills through a service, and then productize that through some sort of software. I think the simple answer is, you know, as an investor, you only consider the traction that you're investing into. So if we're investing into the product, but you've generated revenue through another means, whether it's consulting or doing something else, we wouldn't take it into account. So therefore, I would say it's probably irrelevant, the consulting revenue, for what I'm investing into.
All right, I've got another question here, just asking about dilution in general. Who would like to take that? Tina, maybe you can talk a little bit about just the general concept of dilution, pre and post money valuations, and that whole cycle.
Okay, so just definition about dilution is just diluting your shares. When you have new investors coming into your company, then you give them part of your shares, which means that majority of the people in your cap table, their percentage shares will be diluted. So it will reduce over time. So as a founder, you end up the percentage you own in seed stage has reduced, and when you've reached your Series B or Series C or Series D. So that's dilution. Is there anything I'm missing? Like, do you want to expound on the question?
I think it's worth, I mean, the question is pretty much what I just mentioned, but it's worth mentioning that even though the portion of the company that you own might be reducing, you might be going from owning 100%, then you raise some funds, you give away 20%, you give away another 5% to your early employees, and then you're left with 75%. That 75% is probably more valuable than your original 100%, because chances are you would have grown, and chances are you would have used that money to grow. So it's worth noting that as your ownership gets diluted, that's really what the term dilution means. As your ownership gets diluted, you are looking to raise the amount, the absolute value of your shares within a company. I think we can jump over to another question. Right, so please forgive me if I say this name wrong, but I read it as Oluwatobi. What advice would you give a technology startup with high operating cost and long receivables collection period who prefers debt structure rather than equity? What sort of financing would you recommend for such a company? Who would like to take that question on?
Happy to give it a go. I would just say, like, you know, most debt providers are only going to give you debt if your operating cash flows can afford it, right? So if you've got enough margin in order to pay back interest or pay back a portion of the capital. So, you know, if you're a tech startup, you've got very high operating costs and long receivables collection period, you probably don't have a lot of operating cash per month, and therefore you can't sustain debt. And that's something any investor or debt provider is going to look at. So unless you can find debt that is kind of a a bullet and interest repayment loan where you get the debt up front and you don't have to pay anything until the end of the term. That would be great. Maybe there's other ways to raise capital. Maybe the country you operate in has some sort of incubation programs or some sort of support for tech startups. That could be something to look at. But I think the important point is, if someone's going to give you debt, you need to be able to prove you can afford it.
Yeah, so I think it's an important point, because actually I personally have been involved in trading businesses with extremely long sort of repayment cycles, up to sort of 9 months. And it's really important that you have the right collateral. So whether you've got bonds or something else, or even stock to mark against that debt, then you're probably able to do it. But it is going to be difficult. There are letters of credits and other instruments you can use, which could be useful, especially if you're importing goods and so on. So it's worth looking into that. Right. So next question. What have we got? From another anonymous question. We've got, what are the best negotiations for investments who want a large chunk of your business, even when you have a high valuation, yet struggling with operations due to lack of finance? Would it be safes, equity, or debts? Marvin, maybe you want to take this one on, seeing as it talks a little bit about deal structure, and you've been talking quite a bit about that.
Yeah, as a classification, as a clarification, we talking about the one that says what are best negotiations? That question?
Yeah, because I believe we've answered more, or no, we haven't. But yeah, that's the question I'm speaking about.
Yeah, of course. So the question is, as Rusab said, what are the best negotiations for investors who want a huge chunk of your business, even when you have a high valuation, yet struggling with operations due to a lack of finance? Safes, equity, or debts? There's two parts to this answer, and I guess I would answer this both as the workshop and data that we're doing, and then also as a founder. As a founder, those people who, unless that person is providing you with data-driven reasons for why they want a huge chunk of your business, then they probably are not the right investor for you. And nowadays, there's tons of other capital that you can find where people are going to give you data-driven reasons to invest in a company. Second part, on the type of instrument, I would imagine that our investors approaching you are thinking that they need a huge chunk of your equity of the business. Should you be able to understand and explain safes very cleanly and clearly, or convertible debts very cleanly and clearly, they'll understand that they don't actually need to hold a huge chunk of your company, because if they do that, they would be destroying, or at least making it much more difficult for you to raise money in the future. It is much better to own 1% of a $200 million company than it is to own 50% of a company that is worth $1 million. So being able to explain why you having a huge chunk of my business is actually going to make both of us not make money is probably the direction that answer would need to take to that kind of investor. Hope that's helpful and actionable.
Right. I think we've got another question on expenses. Mark, you've been a serial entrepreneur. Do you have any advice for that anonymous attendee?
So is it the expenses question?
Yeah, that's the one I'm looking at.
Okay. Well, I can give you my personal experience, because it's true that I founded a bunch of companies. The one thing I'm very bad at, is numbers. And what I mean is I just hate accounting. So my first port of call every time I'm creating a new company is hiring an accountant. And that guy tracks everything. And honestly, if you look into the accountancy world, when you are heads on your venture, you don't have time to count the beans. Sometimes you pay an invoice, or you make a small investment, whatever. But you need to collect all those things. And the best thing to do is hiring an accountant, even part-time. It costs nothing. Okay, particularly in our geographies. Okay. It's a matter of pennies. and the guy will do, all the nitty-gritty work. So you can use online tools. Just to give you a view as well, all my personal expenses are on Expensify, just because it's so simple. Okay, you just scan the invoice, it goes into the things and done. All my accounting is done in Wave. I know that now Wave is not available anymore in our geographies, but I'm doing all my invoices, expenses, and P&L in Wave. Very simple. So pick the right tool and hire somebody.
Right. So Kelvin has had his hand up pretty much the entire session. I think we should allow him to speak. Kelvin, we're gonna give you the opportunity to unmute now. Kelvin, do you have a question for us? Seems like he's not available. I've just asked him to unmute. Anyway, if he responds, he will. I think the last question that we have that's currently still open asks, are there any opportunities in VCs for students in Africa who are interested in learning about that? Tina, looks like you've just answered that, but I guess for the benefit of everyone, maybe you can just talk about it quite briefly.
Yeah, so I did a small crash course back when I was at VilCap, and it's done by Kaufman Foundation. So they've been in this VC space for the longest time. They're based in the States, however, but you can use, it's the same juggle, it's the same concepts. And if you do that course and then start talking to a couple of local VC firms and maybe volunteer or ask to do an internship there, that would be a really good value add so that you can apply it in African context.
Definitely, yeah. And just I guess me, when I got into VC at the young age of 20, I remember a book that really helped me was I think it was called Venture Deals by Brad Feld. I don't know if any of the other panelists have heard of it, but that is a useful.
I think
useful
they're
one.
the same people, the same organization.
Yeah.
Yeah.
Anyway, right. I think we're done with the questions, and it would be really good to dive into our big surprise regarding the toolkit. So I'll hand over back to Marvin to sort of summarize and make some closing comments.
Thank you, everybody. So during this conversation, we've learned about how to value a company, how to run a due diligence, how to think about equity and cap tables, all of these fundamental things. If, like Tina was saying very well, the Kaufman Foundation, this was like a 6-week course crashed into an hour and a half. So it's a lot of information. So as a team, what we decided we would like to do for the community and founders is something that we've done in the past, is to basically send you the stuff. So we just went over like 20 something questions. It's gonna be difficult to retain that information because we're all very busy people. So I'm gonna share my screen because a big part of our culture and what we wanna do is create things that are actionable. So what we've put together is a founder's toolkit that will be sent next week to your emails to everybody who attended this workshop. That founder's toolkit will be made up of 4 different things in a file that you'll be able to download and access. First is gonna be contracts, so a SAFE, advisory agreement, a couple different contracts that we think might be very useful for where you are on your journey based on the responses in the poll. Second thing is going to be a cap table template. So you can take that template, use it as well. Is someone just
Yes.
speak? Hey, what's up?
Hi.
Hi, how are you?
Sorry for interruption. Yeah. My name is Kelvin.
What's up, Kelvin?
Kelvin, yeah. I had a question, but I had an issue with my Wi-Fi. So my question was, I'm about to raise 100,000 Kenya shillings, but I'm in a pre-seed also. So this investor of mine is asking for like 10% of equity, where we need the money to raise the money first for prototype. Then we do the small marketing, this Facebook and what. But she need an exchange of 10% for that money. So I was asking, are we doing the right thing, like taking the money for 10%? Is it that the good valuation? If I can ask for just an advice.
Of course. So one thing I should say, this is not advice, it's information. And for this investor, all you got to communicate is this is simple. You said 100,000 Kenyan shillings, right, Kelvin? That you're raising in this round from this investor, right? Okay, I will assume it's 100,000 Kenyan shillings. I believe that's what I heard. If that investor invests 100,000 Kenyan shillings, okay, thank you.
Yeah, I say 100,000 Kenya money for 10%.
Okay, and what kind of company are you building, Kelvin? Is a tech startup, I believe?
Yeah, my company is about, it's all about tech industry. It's in the tech industry.
Okay, all you would need to communicate to this investor is that if they invested 100,000 Kenyan shillings in your company for 10% of the company, that means the company's valuation will be approximately 1 million Kenyan shillings. So if anybody who doesn't have familiarity with Kenyan shillings, 100,000 Kenyan shillings is $1,000 US. So that means that the valuation of the company at 10% would be 10,000 US. That literally would mean that your ability, Kelvin, in the future to raise money is going to be significantly more difficult due to this person wanting to buy 10% of your company, not out of malice, I believe at all, but because I'm not sure they're understanding the mechanics of how investing in early stage technology companies work. So that'd be my suggestion for you, is to communicate it that way, that look, if you take in 1% of the company for 100,000 Kenyan shillings, this is the amount of money that we can move towards as we grow the company. But if you're taking 10% of the company for 100,000 Kenyan shillings, we are reducing the chances of this company being a success. So I hope that that's helpful when you speak with that investor. Thanks for your question, Kelvin. Glad we can get it in. As for the Founders Toolkit, contracts.
Yeah, thank you. I guess, yeah, thank you.
No problem, man. Thank you for answering the question. Sorry, I didn't mean to cut you off. I thought it was muted already. For the Founders Toolkit, everyone will receive an email who attended this workshop today, because y'all are busy people. We appreciate y'all taking the time to be here, be engaged, ask the questions, and building your companies. And we know how difficult that is. So we hoping that this toolkit will make that easier. It will be made up of 4 things. Some contracts, so you said, cap table template that you can use, a diligence checklist in case you're fundraising now or fundraising in the future. And the questions from this session, we will write out in an FAQ that you'll be able to access in this email as well. So we look forward to sending that to you all next week, getting your feedback, and hopefully that thing helps y'all. Otherwise, for the workshop, thank you to everybody who took the time to attend today, every single attendee, Raise team, everybody of these different startups, founders, investors, lawyers, Jessica, Mark, Nivesh, Chris, we're very happy that you took the time to be here today and the effort in preparation to be here and explain very simply these concepts. And of course, a shout out to the Raise team, Tina, Rushab, who prepared for this diligently, Samantha, who put this together and is organizing everything behind the scenes, who has the power between all of our mics. And of course, to Azichi, who joined our team recently, who put this workshop together from scratch, collected the requirements, advertised, all the things that you've seen, put this together for you. This is not the last one. We will be hosting these regularly every quarter, once a quarter, based on demand. We used to do them in person, now they're virtual, and we hope to see everybody at future versions of this. So thank you everybody for coming today. Have a wonderful, wonderful weekend, because it's basically the weekend at this point. And looking forward to check out your inboxes next week. Yes, Mark, it is the weekend. It's Thursday in a pandemic. It's the weekend. And then
there's no weekend in the pandemic. It's 24-hour work.
Or it's always a weekend. Depends on your outlook of it.
Every day Saturday.
Every day is Saturday. And yeah, Mark, thank you. Thank you, everybody. Have a wonderful day and take it easy. Bye-bye.
Thank you. Ciao, bye.
Thanks, everyone.
Bye.
Bye-bye.
Is Sam there?
Yeah, I'm here.
Yeah, but people are still on the call.
Did you do the record? Did you record?
Yeah,
yes, it's actually still recording.
Okay, great.
Yeah.
I'll leave. Thank you, everyone. It was really very impressive.
Yes, yes. And Rushab, you're really good at facilitating. So it was good listening to you as well. I mean, everyone, but I just wanted to give a special thanks to Rushab.
Thank
Have been
you.
the others.
Yeah.
Next time, this one's on Tina. I'm now. I'm supposed to be coding.
Well, like Rishabh, you're just unfolding your hidden gems.
Of course. Yeah. Right. Cool. Do we need to, what's the word, debrief, or should we have that on our next stand-up or something? Obviously, we have 14 attendees on the call, so.
Yeah. We can do it when we're doing the retro on Monday.
Perfect.
Okay. Ciao, everyone. Bye. Thanks.
All right. Bye, guys.